The silver repricing signal, COMEX inventory. Squeeze at $73, 2026 analysis. 3 words that Wall Street hoped you would never put together. Right now, inside the vaults that control silver's price, something is disappearing. The paper promises are no longer matching the physical reality. And when that gap finally closes, 73 will not just look cheap, it will look like the greatest mispricing in a generation. The question is not whether this repricing is coming. The question is whether you will be positioned before the rest of the world figures it out. Welcome to Financial Crisis Explained, the one place where the numbers are never dressed up, the one place where the story behind the market is told exactly as it is. Now, before we go any further, a gentle request. You know that one thing your doctor keeps telling you? Don't delay. Don't wait. Do it today. That subscribe button right there works exactly the same way. One click, no paperwork, no appointments, no waiting room. Just press it. And every time this market moves before the headlines catch up, you will be the first to know. And one more thing before we begin, where are you watching this from today? Drop your city, your country, even your neighborhood, right there in the comments below. Because this story we are about to tell does not belong to one market or one nation. It belongs to anyone paying attention. And today, that is you. It is Friday, May 1st, 2026. Silver is trading at $73 an ounce. To the casual observer, that number looks like progress. It looks like a metal that has had a decent run, a commodity that has quietly appreciated while the world was busy watching technology stocks and central bank press conferences. To the average financial commentator, $73 silver is a footnote, a data point, something to mention between the bigger stories, but this is not a story about a number. This is a story about what is happening beneath that number. And what is happening beneath that number is one of the most structurally significant developments in the commodities market in over a decade. To understand why silver at $73 is not the end of a move but the beginning of one, you need to understand how silver's price is actually constructed. Not how it appears to be constructed, not the version that gets explained in introductory finance courses. The actual mechanism, the architecture that sits behind the price you see on your screen every morning. Silver, unlike most commodities, operates within a dual market system. There is the physical market, where actual silver changes hands, where manufacturers purchase it for industrial use, where refineries process it, where investors take delivery of real, tangible metal. And then there is the futures market, specifically the COMEX, the commodity exchange in New York, where paper contracts representing silver are bought and sold in volumes that dwarf the physical market many times over. For decades, this dual system functioned in a particular way. The paper market set the price, the physical market followed, and the reason the paper market could set the price was simple: volume. When you can flood a market with paper contracts representing silver supply, you create the appearance of abundance. You simulate a market that has more silver than it actually does. And in markets, perception often becomes reality, at least temporarily. This is the architecture that serious analysts have been studying for years. And in 2026, that architecture is showing cracks that can no longer be ignored. Here's the first crack. COMEX silver open interest has collapsed to levels not seen in well over a decade. Open interest, for those unfamiliar with the term, represents the total number of active futures contracts in the market. It is essentially the volume of paper promises outstanding at any given moment. For years, that number remained elevated because elevated open interest was the mechanism through which price could be managed. More paper in the market meant more simulated supply. More simulated supply meant lower prices. But open interest is collapsing. The paper is retreating. And when the paper retreats, the physical reality of the market begins to surface. Here's the second crack, and this one is more serious. The registered inventories at COMEX, meaning the physical silver that is actually available and eligible for delivery against those futures contracts, have fallen to a coverage ratio of approximately 13.15% against outstanding open interest. Read that number carefully. For every 100 ounces of silver that has been promised through paper contracts, only 13 ounces of physical silver actually exist in those vaults to back those promises. That is not a tight market. That is not even a stressed market in the conventional sense. That is a market operating on a structural fiction. A fiction that has been functional for years because most paper contract holders never actually demand delivery. They roll their contracts, settle in cash, and move on. The system depends on that behavior continuing indefinitely. But behavior changes. Incentives shift. And when enough participants in a market decide they want the real thing rather than the paper promise, the coverage ratio stops being an abstraction and becomes a crisis. This is where silver stands today. Not at the end of a rally, not at the peak of a speculative bubble, but at the precise moment when the gap between paper reality and physical reality has become too wide to sustain quietly. The architecture of silence is ending, and what comes next will not be quiet at all. How silver's price has been engineered. There is an old principle in financial markets that has survived every crisis, every reform, and every regulatory overhaul of the modern era. It is not written in any textbook. It is not taught in any MBA program, but every serious participant in commodity markets understands it intuitively. The price of anything is not determined by what it is worth. It is determined by what the dominant narrative says it is worth. And whoever controls the narrative controls the price. For silver, that narrative has been controlled through one of the most sophisticated mechanisms in modern financial history. A mechanism so elegant in its construction, so invisible in its operation, that most investors have spent decades participating in a market without ever understanding the rules by which that market actually functions. To understand the paper fiction, you must first understand the fundamental design of a futures contract. When an institution sells a futures contract for silver, it is making a promise. It is saying that at a specified date in the future, it will deliver a specified quantity of silver at a specified price. That promise enters the market as open interest. It becomes a data point. It becomes part of the visible supply picture. And here is where the architecture becomes consequential. If you sell enough of those promises, if you place enough paper silver into the market through short contracts, you do not need to actually possess the silver to influence its price. You only need the market to believe that the silver exists. The simulation of supply is sufficient to produce the effect of supply. Prices fall not because silver became more abundant, but because the paper representation of silver became more abundant. This is not a conspiracy theory. This is a documented, understood, and legally permitted mechanism within commodity futures markets. It is the structural reality that serious analysts have been mapping for years. And in 2026, that structure is approaching the moment that every engineered system eventually faces. The moment when reality refuses to cooperate with the narrative any further. To appreciate the significance of this moment, consider the historical precedent. In 2011, silver reached $49 an ounce. At that point, physical demand was accelerating, industrial consumption was rising, and the gap between paper supply and physical reality was becoming visible to a growing number of market participants. What happened next was a textbook demonstration of how the paper mechanism operates under pressure. COMEX margin requirements were raised 5 times in 9 trading days. The cost of holding silver futures contracts increased dramatically and rapidly. Leveraged positions were forced to liquidate. Open interest collapsed, and the price fell from $49 to below $35 in a matter of weeks. The physical silver did not disappear. The industrial demand did not evaporate. The structural fundamentals did not change. What changed was the paper market's ability to reassert narrative control through the blunt instrument of margin manipulation. But here's what that episode also demonstrated. The suppression was temporary. And every year that followed, the structural gap between paper promises and physical availability grew incrementally wider. Each cycle of suppression required more paper, more coordination, and more institutional willingness to absorb the costs of maintaining the fiction. By 2026, that willingness appears to be exhausting itself. The registered inventory figures tell a story that cannot be reframed through narrative. When coverage ratios fall to 13.15%, when open interest retreats to levels last observed in 2009, when the paper market begins contracting rather than expanding, it signals something specific. It signals that the institutions which built and maintained the paper fiction are quietly stepping back from it. They are not announcing this. There is no press conference. There is no formal acknowledgement. There is simply a gradual, methodical withdrawal from the positions that made the fiction sustainable. And in the silence of that withdrawal, the physical market is beginning to reassert the authority that paper temporarily displaced. This is the moment that serious analysts have been studying for years, not with excitement, not with the breathless enthusiasm of someone who has discovered a secret, but with the measured recognition that structural transitions in commodity markets follow patterns. They follow precedent. And the precedent, examined carefully and honestly, points in one direction. The paper fiction is unwinding, and what replaces it will be priced in physical reality. Convergence of a once-in-a-decade setup. In any complex system, a single anomaly is a curiosity. 2 simultaneous anomalies become a pattern worth examining. But 3 independent variables drawn from entirely separate corners of the same market, all pointing in the same direction at the same moment in time. That is not a pattern. That is a confirmation. And in the language of serious market analysis, confirmation of this nature does not arrive frequently. It does not arrive on schedule. It does not announce itself through headlines or analyst reports distributed to mass audiences. It arrives quietly. It arrives in the data. And it rewards only those disciplined enough to be reading the data when most of the world is reading something else entirely. In May 2026, 3 signals have converged inside the silver market simultaneously. Each one, examined in isolation, would be significant. Examined together, they constitute the most structurally compelling setup this market has produced in over a decade. Understanding each signal individually is necessary. But understanding what their convergence means collectively is what separates strategic intelligence from ordinary market observation. Signal 1, the paper retreat. COMEX silver open interest has collapsed to levels approaching those last recorded in 2009. This is not a minor fluctuation. This is not seasonal adjustment or routine position unwinding. This is a structural contraction in the paper market of a magnitude that historically precedes one of two outcomes. Either the physical market absorbs the vacuum left by retreating paper and price stabilizes at a new equilibrium, or the physical market, already under inventory pressure, enters a repricing cycle that moves faster and further than consensus expectations anticipate. The significance of this signal lies not in the direction of open interest alone, but in the velocity of its decline. Markets that contract gradually allow participants time to adjust, to reposition, to absorb the transition incrementally. Markets that contract at the current rate of COMEX silver open interest compress that adjustment window dramatically. What would ordinarily be a measured transition becomes a compressed event. And compressed events in commodity markets have a consistent historical characteristic. They are violent in their resolution. Signal 2, the physical drain. The registered inventory coverage ratio at COMEX currently sits at approximately 13.15%. But to understand why this number is the most critical data point in the silver market today, you must understand what registered inventory actually represents within the delivery system. Registered silver is not simply silver that exists somewhere in the world. It is silver that has been specifically designated, audited, and made available for physical delivery against active futures contracts. It is the inventory that the paper market is theoretically backed by. And at 13-15% coverage, the system is not merely stretched. It is operating at a structural deficit that has no credible resolution pathway within current inventory trajectories. Consider what that number requires in practical terms. For the paper market to function without a delivery crisis, registered inventory must either increase significantly and rapidly, or open interest must continue contracting to match the diminishing physical base. Both scenarios carry consequences. Inventory increases of the required magnitude would demand physical silver that the market currently cannot locate at $73 per ounce. An open interest contraction of sufficient depth to restore coverage ratios would represent a complete structural dismantling of the paper mechanism that has defined silver price discovery for decades. There is no comfortable resolution. There is only the question of which form the resolution takes. Signal 3, the ratio speaks. The gold to silver ratio currently stands at 63 to 1. 1 ounce of gold purchases 63 ounces of silver at current market prices. To the uninitiated, this number carries little meaning. To anyone who has studied the historical relationship between these two metals across centuries of monetary and industrial history, it carries extraordinary meaning. The long-term historical average of the gold to silver ratio sits between 40 and 50 to 1. During periods of genuine physical scarcity, during moments when silver's industrial demand converged with monetary demand, the ratio has compressed to 30 to 1 and below. At 63 to 1 in 2026, silver is not merely undervalued relative to gold in the abstract sense. It is undervalued relative to every structural and historical measure that serious analysts apply to this relationship. Mean reversion in the gold to silver ratio is not a speculative thesis. It is one of the most reliably documented phenomena in commodity market history. The ratio does not remain at extremes indefinitely. It compresses, and when it compresses from a position of simultaneous physical scarcity and paper market contraction, the compression is not gradual. This is the architecture of the three signals, each one independent, each one individually significant, but their simultaneous presence in the same market at the same moment creates something that transcends individual analysis. It creates confirmation. In the entire recorded history of the modern silver market, these three signals have aligned with this degree of simultaneity on exactly 2 prior occasions. On both occasions, what followed was not a modest price adjustment. What followed was a fundamental repricing of silver's relationship to every other asset class in the financial system. The third occasion is not approaching. It is already here. What serious decision makers are doing right now. There is a specific quality of silence that exists in markets just before a structural transition becomes visible to the general public. It is not the silence of nothing happening. It is the silence of the right people moving quietly, methodically, and without announcement. It is the silence of decisions being made in boardrooms and treasury departments and family offices that will never appear in a press release. It is the silence that precedes the moment when the rest of the market looks up from its screens, sees what has already happened, and asks the question that always arrives too late. Why did nobody say anything? The answer, as it has always been, is that somebody did say something. The data said something. The inventory figures said something. The open interest collapse said something. The gold to silver ratio said something. Everything that needed to be communicated was communicated through the one language that markets never lie in, the language of structure. And the people who were reading that language were not talking about it publicly. They were acting on it privately. This is the nature of every strategic window that precedes a major repricing event. And understanding that nature is the first and most important step toward positioning yourself on the correct side of what is coming. The strategic window in silver today is defined by a specific asymmetry that serious analysts identify as one of the most favorable risk profiles in commodity market history. Asymmetry, in investment terms, means that the potential magnitude of a positive outcome significantly exceeds the potential magnitude of a negative outcome from the same position. It is the condition that serious capital allocators spend entire careers searching for, and it is precisely the condition that the three signals examined in Part 3 have collectively created in the silver market as of May 2026. Consider the downside case with intellectual honesty. If every signal examined in this analysis is premature, if the paper market stabilizes, if registered inventories recover, if the gold to silver ratio holds at current levels indefinitely. In that scenario, silver at $73 remains silver at 73s. The downside from current levels, even in the most pessimistic structural scenario, is limited by the same physical demand fundamentals that have been building beneath this market for years. Industrial consumption of silver is not speculative. It is documented, contracted, and accelerating across the solar energy, semiconductor, and defense manufacturing sectors simultaneously. Now consider the upside case with equal intellectual honesty. If the paper fiction unwinds at the velocity that current open interest contraction suggests, if registered inventory coverage reaches a genuine delivery crisis, if the gold to silver ratio compresses from 63 to 1 toward its historical mean of 40 to 1, in that scenario, silver does not move modestly. Silver reprices fundamentally. A ratio compression to 40 to 1 against current gold prices implies silver above $115 per ounce without any movement in gold whatsoever. A compression to 30 to 1, which has occurred twice in modern history under conditions less structurally compelling than the present, implies silver approaching $155 per ounce. That is the asymmetry. That is why serious decision makers are not waiting for confirmation that the rest of the world can see. Across institutional channels, the behavioral evidence of strategic repositioning is already visible to those who know where to look. Physical silver premiums over spot price have been quietly expanding for months. The gap between what paper says silver costs and what physical silver actually trades for in the real market is a leading indicator that professionals monitor closely. When that premium expands persistently, it signals that the physical market is pricing in a reality that the paper market has not yet acknowledged. That gap is expanding in 2026 with a consistency that cannot be attributed to temporary supply disruptions. Simultaneously, sovereign entities and central banks across multiple jurisdictions have been increasing their precious metals holdings at a rate not observed since the period immediately preceding the 2008 financial restructuring. These are not speculative actors. These are institutions whose mandate requires them to move ahead of crises rather than in response to them. Their behavior is not commentary. It is intelligence. And at the corporate level, businesses with significant commodity exposure, manufacturers dependent on silver for industrial processes, technology companies whose supply chains run through silver-intensive components, are quietly securing forward supply at current prices. They are not doing this because $73 silver is expensive. They are doing this because their procurement analysts have run the same structural numbers that this analysis has examined, and they have reached the same conclusion. Securing supply today is cheaper than competing for supply during a repricing event. The cost of inaction in a strategic window of this nature is not abstract. It is mathematical. Every repricing event in commodity market history has followed the same behavioral sequence. First, the signals appear in the structural data. Then, informed institutional actors begin repositioning quietly. Then, the signals become visible to sophisticated retail analysts and smaller institutional players. Then, a catalyst, sometimes predictable, sometimes entirely unexpected, converts the structural tension into visible price movement. And then finally, the general public becomes aware that something significant has happened. At each stage of that sequence, the opportunity compresses. The window that exists at stage 1, when the signals are present but the broader market has not yet registered them, is always the widest window. It is always the window with the most favorable entry conditions. And it is always the window that closes faster than anyone who missed it believes it should have. Stage 1 of that sequence in silver's 2026 repricing is not approaching its end, but it is not in its early innings either. The signals have been present long enough that institutional repositioning is already underway. The window remains open. But the architecture of every prior repricing event in this market suggests that the distance between where this analysis sits today and the moment of public recognition is shorter than the distance already traveled. The silver market in May 2026 is not presenting a speculative opportunity dressed in the language of analysis. It is presenting a structural reality that has been built methodically over years, confirmed by 3 independent signals simultaneously, and is now approaching the moment of resolution that every structural imbalance eventually reaches. The decision that serious decision makers are making right now is not whether this repricing will happen. The structural evidence has moved that question beyond reasonable debate. The decision they are making is simpler, more immediate, and more consequential than any market prediction. It is the decision of whether to act while the window exists, or to explain later why they waited until it had already closed.